This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. We're going to work through question 4 of the December 2010 paper F9 exam. So make sure you've got the question in front of you. And as always, go straight to the requirements. Part A, 5 marks. Calculate the equity value of NN company using the following business valuation methods. 1. Dividend growth model. 2. Net asset value. That looks fairly standard. 5 marks. Hopefully it's not too hard. B. Calculate the after-tax cost of debt. 4 marks. Again, even before I've looked at the body of the question. That's fairly standard workings. We should be able to do that quickly enough. And part C, the weighted average after-tax cost of capital. 6 marks. Again, very, very standard. Now that's 15 marks, but 10 marks writing here. D, discuss the factors to be considered in formulating the dividend policy of a stock exchange listed company. And that's very much separate, so whether A, B and C are very easy or very hard, we should be able to get pretty decent marks on part D. And I only stress that because, in the real exam, if you do get stuck on A, B or C, don't give up. Part D here is effectively completely separate. Doesn't matter how good or bad our arithmetic was in the earlier bits. Anyway, let's start off with part A. Calculate the equity value using 1. The dividend growth model. Well, you should know immediately that you've got the formula on the formula sheet, so write it down. P0 equals D0, 1 plus G over RE minus G. And P0 is the market value that we're after. Now, I'll do it per share and then multiply. You could do it in total from the beginning, but if I do it per share, it means the market value per share what's the current dividend? Well, I know we've a statement of financial position there, a balance sheet, but I'm not really interested in that for the moment. Immediately below it says we've just paid a dividend of 66 cents. The cost of equity is 12%. The dividends have grown at a rate of 3% per year. So times 1 plus G, the growth rate, 3%, over cost of equity, 12%, 0.12, minus the growth, 0.03. And so 66 times 1.03 divided by 0.09, I get 7.55 cents or $7.55 per share. However, that's per share. They want the total market value. So the total market value of the equity how many shares are there? On the balance sheet, ordinary share capital, the equity, is 50 million. But be careful, if you look at the paragraph below the statement of financial position, the last sentence says the ordinary shares have a par value of 50 cents. And so, if it's 50 million on the balance sheet and the 50 cents per share, it means there are 100 million shares. And at $7.55 each, the total market value, $755 million. Now note, A1, all they want is the arithmetic, and so there's the answer. It may worry you a bit that it says, that paragraph I keep looking at below the balance sheet, it says at the very end, it's got a negative market value of $8.30, and yet the dividend growth model gave us $7.55. And it may worry you why they're different. Well, irrelevant to this question, but the answer is quite simply that the market value of $8.30 is based on their expected future dividends. We've assumed they'll grow at the rate in the past of 3%. shareholders may be expecting they're going to grow faster. And they've come with a different market value. However, completely irrelevant here. Part 1's finished. Part 2 wants the net asset value. Well, the only values we've got are the book values on the balance sheet, so that's all we can use, although I'd be very dubious in real life about using these. And, well, what is the market value? The assets are 143 million. The total liabilities are 49 million. So the net assets at the moment, one less the other, is 94. But remember, it wants the equity. Well, equity are your ordinary shares and the retained earnings. Preference share capital isn't part of equity. So we need to subtract the preference share capital, which on the balance sheet is 25. And so the market value of the equity, 143 minus 49 minus 25 is 69 million. Or, of course, the market value of the equity, sorry, not the market, yes, the market value, but using book value of net assets, it's the share capital of 50 million. That's the equity, the ordinary shares, and it's the ordinary shareholders, the equity, are entitled to the retained earnings. So again, 69 million. Anyway, I'm talking too much. That's 5 marks. It's not too bad. Now, what about part B? The cost of debt. Well, the second paragraph below the balance sheet. The long-term borrowings, so the debt, the 7% bonds redeemable in 6 years' time at their par value of $100 per bond. The current ex-interest market price, $103.50. Well, very standard, to be honest. If you have problems here, have a look back at the course notes and then have a go yourself. But always do it on 100 nominal. And when they're redeemable, set up the schedule that as of now, the market value, it tells us ex-interest is 103.50. There'll be interest on this for how long is it? 6 years? It's 7%, so $7 a year, but the company will get tax relief. And the last line of the question, 25%. So the net cost to the company after tax is 75% of the $7, so $5.25. In 6 years' time, they're redeemed. And it says they're redeemed at par, so 100. Well, the cost of debt is the internal rate of return of those flows. And so, no quick way, we've got to do 2 guesses and approximate. When it's debt, I always start at 5%, so 5%. I've lost my tables. Hold on a minute, here we are. 6 years at 5%. The annuity factor is 5.076. For the redemption, the ordinary factor, 6 years at 5%, is 0.746. Which gives a net present value at 5% of 2.25 negative. If it's negative at 5, then the internal rate of return is less than 5. I'll make a second guess at 3%, but remember any two guesses will do. But at 3%, 103.5. 6-year annuity at 3% is 5.417. The ordinary factor, 6 years at 3%, 0.790. $28.44. The net present value at 3%, 3.94. And so the internal rate of return, we know it's between 3 and 5. It's 3% plus, approximate between the two, assuming they're linear. So 3.94 over 3.94 plus 2.25 times the difference between the two of 2%, which gives me 4.27%. Now, I said before, and remember, any two guesses will have done as long as they're sensible. If you use different guesses, you may get a slightly different answer, but you'd still get full marks. Anyway, that's part B. Finally, part C. What's the weighted average after-tax cost of capital? So we need the cost of each source of finance, and we'll weight by market values. Well, what have we got? We've got equity. And what's the total market value? The equity on the balance sheet is 50 million. But we checked earlier, because they're 50-cent shares, they're 100 million shares. And the equity market value is $8.30. What we calculated earlier is irrelevant. For weighted average, we'll use the actual market value. So 830 million. And the cost of equity, it told us, immediately below the balance sheet, was 12%. We've also got preference shares. What's their market value? Well, on the balance sheet, it's 25 million. Preference shares, the third paragraph below the balance sheet, again, they're 50-cent shares. So 25 million book value, 50 cents, it means there are 50 million preference shares. And their market value is 67 cents. So the total market value of the preference, 33.5 million. Finally, the debt. Oh, I'll come back and get the cost of the preference shares in a minute. Let's put the debt in there. On the balance sheet, where is it? Long-term borrowings, 20 million. The market value of the bonds is 103.5 for every 100. And so the total market value is 20.7 million. And the cost of debt, 4.27%. However, we do need, obviously, the cost of the preference shares. The cost of the preference shares is the ordinary formula, D0 1 plus G over P0, except with preference shares, there's no growth. So just with no growth, it becomes D0 over P0. What's the dividend? Preference shares, where are we? Third paragraph below the balance sheet, the annual dividend is 8%. Well, it's always 8% of nominal, and the nominal value is 50 cents. So the dividend is 4 cents a year on a negative market value of 67 cents. So 4 on 67, it comes to 5.97%. Well, now I'll take a weighted average. The total market value of the company, 830 plus 33.5 plus 20.7 is 884.2. And so, equity, 830 out of 884.2. Preference, 33.5 out of 884.2. And debt, 20.7 out of 884.2. So I hope my arithmetic's right, but my workings are good enough to get all but half a mark if I go wrong now. Let's do it. Equity, I get 11.26. .23. Can't be right. 4.27 times 20.7, 884.2. 0.10. 11.59%. The weighted average cost of capital. Now, I've not checked with the answers, so I can't remember whether that's right or wrong. I think it's right, but even in the real exam, I wouldn't waste time checking. My workings, my approach is right. So even if I've made an arithmetic mistake, that's only half a mark. You know, the marks aren't for the final answer. They're for the approach being correct. However, I think that is right, 11.59. Finally, part D, and as I said before, this is completely separate. But there's 10 marks here. You can't afford to waste 10 marks. Too many people just don't do the written. And there's some very, very easy marks here. Discuss the factors to be considered in formulating the dividend policy of a stock exchange listed company. Well, when I say a few easy marks, surely one obvious one in deciding on the dividend is the cash availability. So factors to be considered. The cash availability. Or cash available. I can't spell. Clearly, the most dividend they can ever pay is the cash that happens to be available. That's going to be a prime factor. Another one, legal considerations. The main one being that although clearly we can't pay a dividend if we haven't got the cash, whatever cash we've got, the law says, certainly in the UK and I think in most countries, dividend cannot be more than retained earnings. Now, I really do think both of those points are very obvious indeed. The other's slightly less obvious, but let's run through them. It's a good one to learn from. Another one is what's called the signalling effect. Now, it's not good just writing the word. You need to explain. You don't even need to use the word signalling, as long as you can explain. But the point is, if we pay a lower dividend than shareholders expect, then they may be worried that the company has problems. Immediately, shareholders see low dividends. The first reaction will be, if dividends gone down, the company must be struggling, which may not be the case, obviously. They may simply be retaining more to invest. And it not be a problem, but it's something they have to consider. Another factor is very similar, but something called the clientele effect. It is similar, but it's not the same. Some companies pay very high dividends, but don't grow much. Other companies pay very low dividends, but because they're retaining a lot and investing, they're expanding, they're growing. And people invest in companies depending on the sort of dividend they want. That the clientele effect, if shareholders choose this company, if shareholders have chosen the company, because of its dividend policy, maybe they chose it because it was paying high dividends, then there are problems. If the company changes the policy. So I say, if shareholders chose the company expecting, if they chose the company because they've always been paying high dividends, if the company suddenly decides to change and pay low dividends, that's certainly not in the shareholders' interest, and they'll be upset. Another thing to consider. We said at the very beginning, a factor is the cash available, but of course, just because there's 10 million available doesn't mean you pay a 10 million dividend, because companies do retain to invest. So another thing to be considered is what investments are available to use any retained earnings. There's no point in retaining earnings if there's no way to invest it. You only want to retain if you can invest it well and grow the company. So that's something that would have to be considered. And finally, certainly finally from me, but I think I've got most of the points and I'm confident that I'll get most of the marks. Again, perhaps less obvious, but when I say it, it should become immediately obvious, is the effect on the gearing. The reason it has an effect is that surely lower dividend means more retained earnings. And surely this will increase the equity and therefore reduce the level of gearing. Now, I'm not saying this is always going to be a factor or a major factor, but certainly if the company did have perhaps a high level of gearing, then paying a low dividend and retained earnings would be a way of reducing the gearing, reducing the risk as a result. Anyway, that's it, and I hope that's helped.